Okay, so welcome back, everyone. The first thing I want you to do, thank you. The first thing I want every one of you to do is to write two things on paper, two great messages for yourself, for your community, for your partners, whatever speaks to your heart for the past week. Just quickly jot down two thoughts that you're really grateful for. I want to add here that it's actually proven by science that kind of reflecting on your past and having a positive mindset about it, being grateful for it, improves the chances of you succeeding in the future as well. Because it draws your attention to something that you're grateful for, and thus, going forward the next week or the next few days, you'll be paying more attention to it as well. And I think that just makes overall us as a humanity, as a community, a little bit more peaceful and more optimistic and more happy and friendly towards each other. So I'm going to try to do this every week. And you can pay attention to something beautiful that's happening to you from other people or that you do to somebody else through the week. Okay, a recap of the last class. What stuck with you the most? Who can raise their hand and say a sentence or two sentences about something that you remember from the last class? Please go ahead.
I remember everything.
Everything?
And second sentence?
What was yes? What was one thing that was like stood out to you?
The types of companies.
Okay. Was it surprising how many or how little types of companies there?
I remember three. It's LLC, S corporation, C corporation.
Right.
Maybe non-profit, but
Right.
didn't talk about it.
Okay. Nice. Thank you. Valery?
Yeah, I remember about 100 millions and what I would like to do with this.
Okay. Nice. Anybody else?
I can share.
Sure.
So I feel like the last class was really cool because I started thinking about my startups, ideas, and that was like really interesting because especially when I saw the structure in companies, it's like became much easier and simpler to understand. So
It's not the rocket science.
what's that?
It's not the rocket science.
Mm-hmm.
Yeah.
Yeah.
Yeah. So
Became
it's
a little
much
bit simpler.
easier, yeah. So like especially like when but
What?
mentioned about like LLC, C Corp, S
Yes.
Corp, and like wow, it's not that hard to understand how it's worked.
Mm-hmm. Now there's that knowledge somewhere in your head, and you kind of like know how to navigate to it, where to look for, what to look for when you hear those words.
Yeah.
Nice. Thank you. Thank you for sharing that. Okay, I did get some questions from the last class that I wasn't been able to answer, so I'm coming back to them to give you a better, more clear answers this time. So a couple of questions I've got was about the foreign country hires with LLC specifically. So I think somebody, and G, he was asking how can he hire, I think Alexei, you also, right? You were asking about how can I hire people from outside the country and what are the benefits to the company or how to do it. So first I'm going to talk about the LLCs and how to do it. It's actually very easy. All you need is a very clear contract agreement of what is going to be the work that you're hiring this person for. So just say, there's a developer, software developer. Masz, you can sit here. You can sit here. Or if you need a table, we can bring a table as well. So if you have a clear contract agreement where you state exactly what that person is going to do, that is the first step to hire somebody from outside the country. They should send you clear invoices, and then there is a tax form. That form, W8BEN. It's a pretty straightforward form. I think I have it somewhere here that I can show. It's exactly what you would imagine. It's right here. So it asks who they are, what are they going to be doing, and how much are they going to be getting. And that's it. And then you sign it and you give it to your CPA, and they will file it as part of your LLC tax return. And you can claim that as a deduction because it's an expense for a company. Two things that are important to do in this case, because I was asking ChatGPT about, like, can I hire my grandma and pay her money, and she's in Ukraine, and I'm just spending my money from the company here. And it told me that it's not going to work like that. It could work for a couple of years, but then if IRS actually checks, they can ask you for the taxes back on those 2 years. So artifacts of work is important. With the software engineers, it's very easy because you get a GitHub. So when you do some work, you send that work to the cloud for those who don't use a GitHub. So IRS can come to you and say, well, what did that person do? And you can just show them their work. For others, it needs to be very detailed and maybe documented what exactly they did. If it's a marketing agency, maybe there's some posters that they did, some designs that they did for you. So artifacts of work are very important. If IRS comes and asks you a lot of questions, you have that, those artifacts to show them. One cool thing that I found that I didn't know about is that there are these companies called employer of record, and those are the names of companies. Oh, thank you. Yes, these employer of record. So those are the companies who hire people in other countries to be their full-time workers, and you can work with that company to have all that paperwork done for you, and you can get specific specialties, specific engineers, specific designers, anyone who you need in that country, even like hardware factory manufacturing, all of that. So yeah, there's apparently companies who provide these services as well. For the C Corp, there are a couple things. I mean, the pros, like Alexei, you've asked, what are the pros? Why would I want to hire somebody in a foreign country? Why are C Corp so interested in doing that? There's a lot of savings for them, and that's really it. Because there's also a lot of overhead, there's a lot of paperwork they need to do. All of that paperwork mentioned in LLC, but then also because it's a corporation, if they hire too many people outside, they could, so that country, for example, India, right? Like if a software company is hiring a lot of people there, India can start claiming that that corporation is actually acting in India as a corporation as well. And so they can tax them on any revenue or anything that they have there. They can ask for like franchise tax or fees to be paid to that country as well. So it's a balance. It's not always beneficial. But there's a lot of benefits in savings and potentially time as well. Like if you have people working in Ukraine for your company, you go to sleep here, but they wake up and work there. So you kind of like get both, all 24 hours people work for your company. The last thing that I've got last time as a question is the C Corp and the state taxes. Something I want to follow up on. So the C corporations have a federal tax, and it's 21%. So every C Corp pays 21% to the federal, like IRS. But then also every state where that C Corp is registered is going to take state tax as well. And different states have different corporation taxes. I know California, I think it was around 12%. But then some provide you 0% state tax, but they charge you higher fees. Or they have a franchise tax. For example, California also has a franchise tax. If you haven't made any profits, like you lost the money, so you didn't make anything, they will still ask you to pay $850 a year, and that's the franchise tax.
I realized it's not a slideshow.
All right. So now we are moving on to today's material. We're going to talk a little bit. We're going to talk a lot about the equities. So what is the equity? When you create a company, if it's LLC or C Corp, it doesn't matter. But let's say you created a company. Here's your pie, right? This is all of your company, and let's make it an LLC for now. Technically, there are no shares in LLC, all right? There is also only like this operational agreement. It's how much percentage do you own of the company that is written on a document, on a paper. And if you're alone, you own the whole thing. And so that's your equity. This is called equity, right? This is how much of the company do you own. That means also how much assets of that company do you own. If it's not a corporation. We're talking about the LLC for now. So all the assets that you have in this company are technically like of your company and yours, because you are the only owner of that company. All the profits that you get, they're going to be passed through to you, all 100%. But then, let's say you get the second person into your company, right? So now it's a 2-people LLC. And instead of having 100%, you say, well, okay, I'm going to have 70% of that company, and somebody else is going to have 30. So now you split the profits in this proportion. And again, this is the equity. Your equity is now 70%, and another person is 30%. Maybe it's your partner here in the business. This same thing, very similar, happens in corporations as well. So if this is the corporation, you can have it structured similarly, where a lot of different people are going to have a lot of different equity in your company. And there are different types of companies. There's a private one and a public one. Very easy to understand. Public companies are usually the ones that you see at, at New York Stock Exchange, something where you can buy shares. Today you can log in on your Fidelity, Robinhood, Charles Schwab, any broker, interactive brokers, any brokerage, and they have these public shares of other companies that are public companies. You can buy shares, and let's say if you go today and buy one Apple share, and this is Apple, and I do not know who owns how much of Apple, but what happens in case of Apple is this pie is divided into many, many, many thousands and thousands of slices, right? So when you buy a share, one share, at a price of, I think it's around $200 today, so you will have yourself owning 0.0000001%. And you will have equity in Apple. And what happens here is that when they pay dividends, based on this one share of dividends, based on this one share of equity, you will get a little bit of dividends. Usually what they say is, they come out and they say, we will pay, 30 cents per share. That means that, how many shares they have, most likely they have about 150 million shares issued. That means every share is going to get 30 cents, which means they're probably going to pay out about $35 million of dividends. And all you're going to get with one share is you're going to get 30 cents. So this is the public company. It's the company that you can go and buy shares of at any time. You don't need to go through any type of process. It's public to be traded. The private companies, like your LLC, and we'll take a coffee shop, for example, today. So you opened up a coffee shop, right? It's right there on the street. You own it. Nobody else can come and buy it. Like, there is no stock exchange. There is no app that they can open and find your coffee shop and invest it or buy it. So that's the private company. I think it's pretty straightforward. And there is a path. There is a path to take your private company to public company. That path is going to be called IPO, Initial Public Offering. We will get to that much later in our journey, because for now what we are doing is we are trying to build a private company, right? So we're going to talk a lot about the private companies for now. Next week we're going to look at how we do the fundraise, like where do we get the money for our private company, what are the different ways to get money from investors, get money from the banks as loans. So we'll talk about that, and then we'll get to the IPO. Once we've built our big company, we can make it public so that many other people can go and buy the shares of it. Okay, so when we're talking about the equity, we're talking a lot about the percentages of the company, and that is usually reflected in something that's called cap table. So the cap table stands for capitalization table, right there. It shows at any point of time, so this table, it reflects how much equity does any individual in the world owns of your company, whether it's public or private. And it can look like this. There's a founder A. So what happens here in a cap table, we can list out the founders, and in this case we have 3 founders, and then we have 1 investor, and let's say the founder A, somebody who has created this coffee shop, right? They've put a lot of money in it. They've been working on this company for a year and a half, and then they want to bring a great marketer. They want to maybe scale the marketing for this coffee shop. They bring somebody and they give some equity to them. So now that person doesn't just come as a full-time employee and they get salary, but they also have equity. Then we bring the 3rd founder, maybe he's a technical founder or somebody who knows the equipment very well, or they have some formula for the bakery. So we can add them to our founding team and give them 5%. And then we also want an investor who is going to bring some money for us to operate with, and we will add 5% more to them. So this is the cap table that at any point of time, you as a founder A usually, it's your responsibility to keep track of who owns how much of your company. And we are going to take a look at how does this cap table evolve through the course of the, a lot of funding rounds. Let's find the table for the great people, and we'll continue. Perfect. Okay. So again, here, this is the very, very simplified way of kind of like imagining the cap table at this point. I'm going to show, yes?
So if I'm founder A, right?
Yes.
I was thinking other people will be like employees, but they have a part of my
Company.
how come?
So this is your choice. It doesn't have to be this way, but it incentivizes people to work harder because they actually, if the company grows, right? So if I'm a full-time employee and I come and write software for somebody, or let's say coffee shop example, I come in and I'm barista and I'm making coffee, I don't really care how much coffee I sell, right? All I get is an hourly wage. I get my contract. I get paid. Doesn't matter how many coffee cups I'm going to make a day. So that's the employee. If I'm a founder of a coffee shop, and I know that this person, they also have marketing background. They're a great marketer. And what I want is I want to be really engaged and really wanting to sell as many cups as possible, because then I'm going to make more money as a company. And because they have equity in it, they will also get part of that. Right? So, and that happens in both LLCs and the corps.
When they will get the money, when the company will be sold?
No. So with the LLC, let's take a look at the LLC quickly. So there is such thing as an operational agreement. And this agreement defines multiple things. One of them is equity, how much each individual is going to own of this company. And then LLC's world, the types of shares, there is only one type of share. So it's not like you're going to make a lot from... Anyways, you can't take LLC public, is what I want to say here. You can still sell part of your equity to somebody else, to like an investor or another person. But you also will be getting, you can be getting some profits from, for example, you say, every cup we sell in this coffee shop, I get 70% profit from it. And you as my co-founder, founder B, you're going to get 20% of it. So you literally get, you just outline in this operational agreement how much money this person is going to get based on how much equity they own. Based on profit. I mean, that's probably the most important part. Because you can't take LLCs public. But if you are, if we are looking at the corporation, right? Even if it's a private corporation, so the corporation doesn't have to be public by default. There's a process to take it public, but it starts as private. What happens here is that having this equity means that you own the piece of company, and we will take a look a little bit later today. Each company has price on it. And the way we price that company is different based on what kind of company that is and what kind of assets do they have, what kind of liabilities they have, all of those things. So I'm going to show them just in a bit. And I think it's going to start making a little bit more sense. What I'm going to do is I'm going to come back to vesting in a little bit. And I think I lost my clicker. Okay, here it is. So I'm going to go here for a little bit to simple cap table. I'm going to continue with this example, and then we'll loop all around. So the cap table doesn't show just the equity, how much equity do you own, but it also shows you how much shares this equity represent. And it's important. I'm trying to think, where am I going to introduce this concept? Okay. Okay, let's just talk about it here. So let's say you don't have an investor yet, right? But you want to bring in an investor. And I think this goes into this dilution part. So who knows what is dilution here? Dilution? Yeah, Andrei knows. Okay. The dilution on the left side. Okay, so we're going to cover this 2 concepts right now, or even 3. First, raising money for your company. Second is putting a price on your company. And the third one is dilution. And I think then a lot of these things are going to make more sense. So you have this company. And I knew I should do it this way. But can everyone see it? There's a lot of text here, but this is the coffee shop that we are starting. Okay? So I'm a founder A. And I bring $60,000 of my own cash into this company. This is an LLC company. Okay? Try not to get myself confused and everybody else. But there are 2 things that I wanted to introduce later in the lesson, but now I kind of understand that maybe it's more appropriate to do it now. The one is the balance sheet. So the balance sheet shows 3 things, and 3 things only. It shows all the assets that you have. It shows all the liabilities that you have. And it shows that. So the assets in this case, I just brought cash, right? So I brought the cash, I put it into the company. These are the only assets I have. I didn't do anything with that cash yet. I didn't even open the restaurant yet. I just registered the company on the website like we did last time. And then I put $60,000 in it. So these are my assets. The liabilities is something like a credit. If I were to take a credit on my company, then I would need to pay some interest on it. So these are going to be the liabilities. And the equity is the difference between them. So if you were to put minus and then equal, this is going to be my equity in the company. So right now we have enough cash to buy some equipment, right? So we're going to buy equipment. And the equipment costs $20,000. Then we need a place. We need to pay rent. And that will be the first month's plus deposit. Pretty standard. Let's say we found the place for $10,000. And let's assume that we are the only founder and it's just us who is going to be working on this company. So we're not going to hire anyone yet. What else do we need for our coffee shop? Coffee? Okay. let's put that as part of the equipment. Equipment plus the commodities, the coffee.
But equipment is usually stuff you buy one time per year, for example, and coffee you will buy
Every time. Okay, let's then break it apart. Let's say the coffee cost us $1,000 to begin with, right? The first batch is $1,000. What else do we need for the coffee shop?
Bills.
License? License. What kind of bills? Utilities? Okay. So the license is going to cost us $1,500 and the utilities is going to be $500. What else? Good. Yeah, marketing. We need marketing. Nobody knows about this place yet.
And people.
For now, it's just us. Let's just for the first months, it's just us. Let's say $1,000 for marketing.
What about interior?
About what?
Interior.
Interior?
Would it be part of the marketing or no? But usually it's.
It would be part of the equipment, most likely, because if we're buying tables, chairs, that will be part of the equipment, not just the coffee machine.
We have in Russian расходники, it means coffee cups, all this.
That would be part here, yes.
Everything comes to the coffee.
Yes. So in English, what you were saying, Maria, that's called cogs. 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 It stands for cost of goods sold. Okay, I'm going to skip the shares. We'll come back to the shares. That's very important stuff. And then we'll talk about this finance stuff first. Okay. So the cost of goods sold is the direct costs of making your product. The coffee beans, the cups, the milk. All of this in English and here in the States, you'll see it on the balance sheet. It's going to be COGS. Okay? So the equipment and rent in this case, in just this first month's case, because we kind of put all this money ahead of time and we can amortize. This is going to be CapEx. So this is going to be a capital expenditure. This is going to be COGS. And then this is going to be operating expenditures. And these are reoccurring things, right? So the rent going forward, the second months, the rent is going to be here. And it will be an operating expense. Coffee is the COGS, the cups, and everything else. Okay, so now what we are ready to do is we can first put this into the P&L statement, the profit and loss statement, right? Or the net income statement. It will look like this. It will look like this. There's going to be revenue. I think I have an example of that somewhere. Probably not in here. Okay, here. It's a very simplified one. But so it's going to be revenue. Then it's going to be expenses that we will break into the COGS, CapEx, OpEx. Where are the salaries go? When we hire somebody, is it going to be the CapEx, the COGS, or the OpEx? Yes, that's correct. So they're going to go into the OpEx because they just come every month. And we don't own them, right? We don't own them as equipment, but they also don't go directly into the cost of the item that we make. Then we're going to have, I think, liability. So things like interest, but we don't have that yet. So I'm not going to overcomplicate it, just what we have. And then we will have profit. So in this case, revenue, the first months, we just opened up. We haven't sold anything yet. It's 0. The COGS are 1,000. Then this stuff adds up to 3,000. And the CapEx is $30,000. Okay? So after we've done this P&L term sheet, we can do the balance sheet. And the balance sheet is going to be all the assets that we have. And in this case, the equipment and our rent and deposit, I guess just the deposit part, is going to be the asset. So the assets here are 30,000 that we own in equipment, and we'll come back to here. We do not have any liabilities at this point, so liabilities are still 0. But we still have some cash left over. So we had $60,000 in cash. We spent 30,000 here, and then we spent 3,000 here. This is 34, and we are left with 26,000 in cash. So we'll just put plus $26,000. And so our equity, we own $56,000 of this business. So what this means is that if we were to sell this business today, even though we haven't opened yet, just for now, if we were to sell it today, we would get $56,000 out of it. And if we are the founder A and we are the only person, and we own 100% of this company, we own all $56,000. Now, we are going to start hiring people and getting the second founder as well. And we are going to run the first months that we've actually operated. So again, we have founder A, founder B, and then we have one employee. So our cost of goods, so let's do the P&L term, right? P&L statement right away. So we're going to do the revenue. And let's say, some number that we actually sold. We sold, let's say 2,000 cups of coffee in a month, and each cup costs, $5 that we are selling it for. So 2,000 by $5, we made $10,000 in revenue, right? Then we have COGS. We've spent $1,000 for coffee, cups, and everything else. Then for our OPEX, we have rent. The rent was $5,000, so I'm going to put rent, 5,000 here. We have now one employee. Let's say they charge us, the employee costs us $3,000 a month. We have all of those like licenses, utilities. We have kind of like other $2,000. I think that's all we have in the OPEX. In the CAPEX, we don't have those 30,000 that we spend in the first months because we're not spending them in this month. However, we have depreciation, and that means that the equipment that we have, it lost some value. So if you remember, we bought equipment for $20,000. And usually what happens, there's different ways to depreciate things, and we can talk about that a little bit later. But the most straightforward one is just a flat depreciation over 5 years. So what we say is, for 5 years, for 12 months, every month we're going to take a piece of that equipment and say, well, now if I were to go and sell it to somebody, like you go on Facebook Marketplace and you put out your coffee machine and the tables and the chairs, well, you can't get $20,000 anymore because you used it, right? So every month, the value depreciates by $333. And so we're going to put it here as an expense. I think marketing, we forgot marketing here. And that was another $1,000. Okay, well now we can calculate the profit for this month. We've brought $10,000 by selling coffee, and then we've spent 8, 10, 11, 12, 333. I'm going to round it up to 12. So our profit is actually minus 2,500. So we lost $2,500 in this month. So what happens to our balance sheet? This is the balance sheet. We used to have assets So we used to have $20,000. This might be not correct. I might be wrong here. I'm sorry for that. I'm going to take this away. I'm going to clarify. I don't think we put it here. The reason why we don't put it here is because we're gonna calculate it in the balance sheet here. So we don't own the 20,000 on equipment anymore. We actually own $19,667, right? So this is our equipment plus the $10,000 in rent plus our cash. We used to have $26,000 in cash. So most likely these $2,000 came out of this cash that we used to have because we had to get it from somewhere. But for now, what I want to do is I actually want to do like a credit. So we have some liabilities here. So let's say we don't want to use this cash because we think we're going to need it for later. We went to the bank and we said, you know what, the coffee shop is doing great. So far the marketing works, everything works. All we need is just to wait a couple more months. People will learn about this coffee shop. We're going to turn profit. It's fine. We're going to come from negative to the positive. So we got a $10,000 loan, and we've spent $2,000 from there. So now we have a liability of $10,000 here. And now we can calculate the equity for our coffee shop. So we have somewhat hard numbers to work with. I'll just put this. So we have 10, 36, 46, 55, 55, 50, 45. So if you remember the previous time, we had, how much? We had $56,000. And now we have $45,500 after just 1 month of operations. So we didn't really lose money, but we've got this liability that we have to pay for. And this is technically the cash that is available to us because we still have $8,000. Okay, there we go. I was like, this doesn't sound right. 3. Perfect. This actually makes sense. Why does this make sense? Because from the first month, we had $56,000. We've lost 2,000, so that was 54, right? And then we also depreciated our coffee machine, but we're just going to do 500 for the sake of the calculations. So this actually comes out to 53,500. So everything is good. Math adds up. We have our liability. We have our cash here. This is the difference between the liability that we got from the bank, but also the loss that we incurred in this month. And so now, as a sole founder, right? Let's say there's no founder here. As a sole founder, if we were to sell this business today, we are going to get back $54,000, even though we came in and put in $60,000. So all in all, we've lost $6,000 in 2 months if we were to just go and sell this business. But then we also brought the partner into this business. And let's say they don't bring any money for now, but they bring expertise. They are incredible marketer, so maybe we can spend less on marketing costs and also increase our revenue because more people are going to know about the coffee shop. But we don't want to pay him anything, or her. We don't want to pay them anything. What we are going to tell them is, hey, if you can turn this minus $2,000 into plus, you're going to get 20% of that, right? So their goal for the next months is to make $20,000, keeping all the expenses relatively low because the COGS are going to go up. And then they can make money, but they will get 20%. I'm going to get 80%, and our employee doesn't get any equity because they get salary, right? So they get $3,000 in salary. So okay, what does that make now my equity in the company look like? Well, now I don't really have $54,000 in the company. I only owe 80% of it, which is 4/5 of that. It's almost divided by 11, 40, something like $43,000. And then my partner here has another 11. And so this is the equity. This is the equity piece. This is the balance sheet. This is the financial kind of terms, the P&L P&L sheet. And this is our cap table here. What kind of questions do you guys have?
It's kind of confusing.
Okay. Let's unpack. What is confusing?
I mean, who gave you the price for this coffee shop? Like, where did you get this 60,000?
60,000?
Yeah, I know, but like, who helped me to understand how much I need, like, have like for this, like, start like my own business? It's like
Right.
where I get this number.
Right.
Like, because for example, for instance, I maybe don't have this like assets number, like you know, like all balance sheet which included.
Yep.
And for me, this is a little bit confusing because here's like this coffee shop is pretty clear, right? But like, if it won't be the coffee shop, if it will be like something completely different.
Like what?
Beauty studio or something for this.
What is it?
I mean, with beauty studio, it's actually will be almost the same as coffee shop because you need to buy like some stuff like and like employee and marketing and reading. But for example, if it will be like some software, like or like
Software, it's very simple. You don't need to have anything.
But you have to pay a lot of to the wall.
yeah.
So with,
It's not the market
You have
price,
to
it's
pay
just equity.
it's not what, sorry?
It's not the market price.
Market, like you mean the numbers specifically?
Yeah, I mean,
Sure.
It doesn't have the.
But okay, guys, one at a time, please. One at a time.
It's pretty, I think, close to the.
So it's clear for some of you, and then it's very confusing for some other people. So can somebody pinpoint, like, okay, so you've mentioned it's very confusing. Where do I get these numbers from, right?
Yeah, like for
So what you do is
start.
right. So what you do is you have an idea, exactly. If you have an idea, you're like, I want to open a company, and you can Google it, right? So what I did today, besides using a little bit of ChatGPT, I also went out and actually double checked some market prices for coffee beans. So, for example, you go on Google and you're like, okay, what wholesale price of coffee, right?
Can I get a proposal?
Yes.
So,
But-
this is not about numbers.
Yes, it's not.
The question was pretty good, and actually that was a good example, for example, application of software. This is a different example, but anyway, the structure is same. So what we start with, we've been thinking about what we need, yeah, the list of needs. And then research how much it costs and everything, and maybe license. So maybe we can create a list of checklist what is needed.
I think what's nice about this, so I think the easy answer to your question, Aline, is the research. So you do a little bit of research specifically on the numbers. What's great about this is that you can create the templates in Excel, right? Or Google Sheets, whatever, any type of software. You create these templates, and you're like, okay, like I understand what the balance sheet is. I understand what the P&L sheet is. And you can put some assumptions, right? So you're like, okay, I think it's going to cost this much. And then what you do is you take a marker, if you want to print it out, or you just highlight the cell, and you put different colors. And you say, okay, the green one is something that I'm really sure about. So like, for example, cups and coffee. Like, I know this is going to cost, and I don't think it's going to change in the months, 6 months from now. Because there could be tariffs, right? Like tariffs could come, the coffee price goes double, and all your business goes down. It's possible. So what you do is you put the green one for like, I'm certain about this. This is gonna like most likely not gonna change. Put the yellow one where like there's some risk. Something could change. Something could go higher. Maybe you couldn't really find the research and you need to talk to somebody. And you're like, okay, well this is yellow. Like I can figure it out. And it also doesn't look like it's going to change, but I should be ready for it to change. And the red one is the highest risk. So for example, what if you do marketing for $1,000 and you get 0 clients, right? So you can say, well, marketing is the biggest risk. Or you buy an equipment and the equipment breaks.
Or you cannot sell it.
Right, you can't sell the coffee. So you highlight in red what do you think the highest risks are. And then you will have this template, right? And you will have this very nice visual picture of what do you know for sure, what you need to learn, and what are the things you need to budget for example, right? It's like, okay, well, if I have $40,000 and it only costs $40,000 to open the shop, that's good, but there is no buffer. Like, I want to add a little bit of a buffer. How much do I need? So you start to find all these unknowns, and you start to budget for them, or you start looking for the answers. So maybe you reach out to somebody who already has a coffee shop, and you go and talk to them, and you're like, okay, well, look, here's my plan. Where do you think the biggest risks are? How much does your coffee cost, etc., etc. So this is basically just to kind of like introduce the templates into your, everybody's kind of worldview, and then you can use them not with these specific numbers, but you put in any type of company. So we can take a software, for example. It's actually probably much simpler with the software, but you also get, so if you want a software company, you will need employees. They will need laptops. That will be your equipment. You need an office. Then how much subscription are you going to be charging on your software that you build, right? Then you can calculate the revenue from there. How many clients you're going to. So like it's the exact same as coffee. The only thing with the software really is that the COGS are much, much lower. Because you don't need the physical products. You don't need the cups. You don't need the coffee beans. You don't need any of that. But you need a lot more on marketing, a lot more on the design, a lot more on the employees and engineering. So you will have a lot of OPEX, some CAPEX, much less COGS. For other businesses like industrial manufacturing, you will need much higher COGS, like buying steel or buying a lot of equipment for that. But the template, the things that you will want to be looking at are going to stay somewhat the same. Yes?
Question: how do you estimate the difference between yellow column and red column? What is your approach? How to understand?
Yeah, I think it's subjective, but what I would do is basically it's like I want it to be actionable. So the green one, I don't need to do anything. I've spent some time, I thought about it, it's done. The yellow one is something that I know most of it. Maybe I've done my research. The coffee today costs $1,000, but if I don't budget for the tariffs, this is really going to change my cost of coffee. My COGS are going to go like through it's important, but I don't have a direct kind of impact on it. Like I can't do anything about it. It's just for me to keep an eye on, right? I can read news, I can be prepared, I can try to save more money ahead of time, but there's not much I can do. And the red one is something that I either don't know a lot about or I need to do something about it. Like my equipment is coming up and I will need to spend $20,000 because we've been using this equipment for a long time. So over time you can see how these things in the table, they can change from red to green, right? And then back again. And you're like, okay, well, I know that later this year I need to replace the equipment. You put it as red. So it's on your radar to address, to save money for. Then you replace it, make it green again. You're like, okay, I don't need to worry about this. So you want to be actionable. That's how I do it.
Yeah. One more. What about the risk? Why do you put any 20+% of the risk any business is supposed to have at the beginning when you do the project?
Yeah. I would say buffering at least. It's like your personal finances as well, where you want to have 3 to 6 months emergency fund. It's exactly the same with the business, right? So whether it's 20% from all your equity, that's one way, or you can look at your monthly, expenses, what your COGS, OPEX, and CAPEX are, and you keep 3 months off. Another great thing here, if you're opening up a business, working with the banks. Like, I know different people have different approach to credit. Here in the United States, it's incredibly beneficial to work with the banks. And it's incredibly beneficial because if you're if you're a responsible person, you have to, you know how to work with money. You're not just going to take the loan, $50,000, $100,000, and go on a yacht, spend it over. No, you're going to actually put it into the business. It's very prudent of you to do that. The reason why, because when you will need money all of a sudden, spontaneously, like tariffs are coming, the stocks are down, things are bad, you need a lot of money quickly, or some money to cover 3-4 months. You know that this is temporary, right? Nothing really changed in how people drink coffee. They still have addictions and stuff. And so most likely they're going to come back. It's just that right now they don't have money. The easiest and most safe place to find money is to get a credit line. The credit line for the business is not the credit card for the customer. The credit cards have 20, 25, 30% interest, which people should never not be paying their credit cards, and we can talk about that. But for the credit line, this is where the businesses look at you, and a lot of personal credit lines, they come from the houses, they come from the mortgage. So if anyone has a mortgage, if anyone has a house, you're most likely have a credit line with it. So credit line gives you 4 to 7% interest, which is a very reasonable interest if you look at like how much money you make in the stock market. So what happens there is you basically bring in the bank as the partner into your business. And you say, hey, look, I know you're going to make money from this, but also will I, if I need it, right? So what they do sometimes for the businesses, they will use some of your cash. They will say, okay, well, you have 40,000 right now, equipment and cash and everything. We'll give you a credit line for 40,000 as well. So whenever you need that money, you don't need to go into your cash. You can use this. Or if something bad happened and you just need to go through this drawdown, you can use the credit line. The credit lines are a really good tool. And what happens there is that if you actually use it, so let's say you buy equipment, but you don't buy $20,000 of equipment with your cash, you buy $10,000 with cash and $10,000 with credit line. Yes, you're paying a little bit of an interest, but you're showing the bank that you're a great partner because you want them to make money and you want to make money, right? Just like in any partnership, any business. Your coffee suppliers, they're making money, right? They're putting some fee. They're making money, but they're more than happy to work with you. They're more than happy to provide you the best coffee beans. What if there is a coffee shortage? You want to have a good relationship with your coffee bean supplier. So what happens here is sometimes you might renegotiate the deal that you have. Maybe you buy a little bit higher volume now. Things like that. The banks are exactly the same. They're like your partners in the business. And they will see that you can pay back that money. They will keep increasing the credit line. And someday it will come in very handy. So that's a little bit of a side step, but I think it's important. Okay. Yes.
Question about this, like such a business as a coffee restaurant,
Yes.
it can be happen anything inside. Like people brew coffee on themselves, they get
Yes.
they say I'm actually in bed after your croissant,
Yes.
whatever. So that do they have insurance?
It's LLC, so there is a liability insurance. Yes.
Okay, so pay separately or just pay for like some insurance. I don't know how it works.
So you can buy an insurance, and if you do buy an insurance, that insurance is going to take care of that liability claim. So when the person spills the coffee on them and they're like, oh my God, the cup was bad, right? The Starbucks, that happens a lot of times. When the person doesn't close the cap, the barista, they give out the coffee cup to you, you spill it, you can sue the Starbucks. You can go to the court, you can say, well, their cups suck. I got some burns on my skin. I want some money for that. So what happens, that's called a liability claim, right? If you have a liability insurance, they're going to take care of that. They're going to negotiate with this person. They might go to court, do all of that stuff, and then pay out the money. But they take premium from you. With LLC, what happens, it doesn't come automatically. So with LLC, what happens is that person can go to court. They can sue the company. And then whatever you have here is equity, right? Cash or assets, equipment. If court finds that you were at fault, if something that business did is actually wrong, they can use these funds to pay out the claim, whatever that person wants for that. And there's reasonability, of course, etc. But they can't go and all of a sudden sell your house. to take that money and pay that person.
Protects you.
Yeah, I would say
Right.
that's all right, but if you go for insurance, so you pay for insurance,
Mhm.
just want to be sure nobody will take money from
Yes.
your equity, so equity will stay in the same place.
Yes.
So you're gonna pay for insurance, what insurance will be on this table?
I would say OPEX.
Okay.
Because it's going to be like a fee, monthly fee that you pay to the insurance company. So it's OPEX. Yeah. Okay. Break?
Break.
God, I'm just warming. Okay. Okay, well, sure. Okay, 5 minutes break. Wonderful. I'm going to continue now. No, not yet. Thank you. Quick question for everyone. Who knows what is depreciation, what is amortization, and what is the difference between them? Andriy? Do you want to tell?
So depreciation is about material assets and amortization is about non-material assets like software, like goodwill, etc.
Yes. Why is it different?
Why is it different?
Yeah.
Good question.
Igor, do you know why?
I believe.
Yeah, let's go.
Because the something material, I mean,
Yeah.
tangible, you can touch
Yeah.
and you can use directly in productions.
Yes.
You use different approach how to depreciate.
Okay.
So, but when we use goodwill or something, we are not able to use the like productive approach.
Interesting. Okay. Yeah.
So it's, I mean, the difference in the models.
Models. Yeah. How to use them.
Yeah. For example, you're not able to amortize the goodwill like in 1 year only.
Right. Yes.
But you can like depreciate the building or the car in 1 year, for example.
Okay. Yeah. Yeah. Perfect. I think there are a couple things that are very important that you mentioned. First, depreciation. You can have different types of depreciation based on how you use, for example, mileage of the car. Or you can say, no, every year I'm just going to do every fifth of the car. I'm going to depreciate it flat. Amortization, because it's not physical thing, it's not actually going to depreciate in what it is. But the time, so usually we can think of patent. So if you have a patent in your company, it usually has an expiration date. So the closer it is to the expiration date means the less time you have left to actually make money off of it. And you amortize it usually just flat over time. There is a second difference. Depreciation, because it's physical, you can also sell it to somebody. So the car, you've used the car for 3 years, you can sell it, and you can still make some money back. And it's called salvage value. Salvage means something that you're going to destroy, but you don't destroy it, you sell it. In amortization, there is no such thing. If the expiration has passed of the patent, there is nothing left for you to sell. So that's why these two things, even though they're very, very similar, depreciation is used with the hardware, something real life, something physical, and amortization is used with something intangible, like software, patents, trademarks, etc. Both of them go into the CapEx. So if you were to spend money on a patent filing, for example, you will put it into the CapEx. Okay. So if you found a brand new way to do coffee, for example, cold brew, right? Before we didn't have cold brew, and then somebody came up with the cold brew. Technically, they could try to patent that, and the expense to do that is going to go into the CapEx. And then you will amortize that expense. Okay, that's good. On that note, I'm just going to double click with everyone, the difference between the OPEX and the CapEx, because it took me some time to kind of like internalize the difference. The CapEx, the capital expenditure, is something that you can either depreciate or amortize, and OPEX is pretty much almost everything else. There's one thing, sometimes the companies have the research and development. So our research and development, it's a gray area, where sometimes it's something that you spend every month and you just do the research and development and you kind of like never really get anything out of it, in that case it's an OPEX. But if you were to actually file a patent again, right, that would go into the CAPEX. So it's an interesting one. With R&D you can like kind of make it fit your story based on what you want to do. Okay, I think I have a couple more interesting questions. This is just to take our brains a little bit off the balance sheets and term sheets and everything. How can you quickly calculate the hourly rate from the annual salary and vice versa? So here, I've said that the employee wants $3,000 a month, right? Which means they want $36,000 a year. How much are they asking for hourly?
So we divide how they work, 160 per month, hours, so it depends how many hours.
Yes, correct. Let's assume 40 hours a week, the very regular one. 40 hours a week. We have 52 weeks in a year. That is about 2,050 or something like that. So the easiest way is to simply divide this by 2,000. So then whenever you hear the annual one, if you want to quickly in your mind to calculate the hourly rate, you divide it by 2,000 and the vice versa you multiply by 2,000. So in this case they're making $18 an hour, which is a pretty good salary for barista here in Santa Monica, because you also get tips. Okay. This is something that we actually just did, which is great. And this is a good question. We spoke a lot about the profit, right? But there are actually two different types of profits. There is a net profit and a gross profit. Who knows the difference? What is it?
Okay, that's it. It's talking about when net profit, it's when company get money after pay for all bills and
Okay.
taxes, salary, and when company take clean money.
Real cash, yeah. And what is the gross profit?
Gross profit, it's when company take the money without any of this list of.
What goes? It can be monthly. What goes into the gross profit? What does that number calculate? Why is it important to have?
All earning money.
All amount of money?
All earning.
That would be net profit.
No, the net profit is after.
All the expenses.
Yeah.
Oh, you mean revenue? Are you talking about the revenue?
Yeah.
All the money that you brought in? That would be revenue. So this was revenue. This was net profit. Gross profit is somewhere in between here.
Before amortization,
Taxes.
Yeah. Are you trying to remember EBITDA? Yeah. That's also slightly different. But the gross profit, it takes the revenue and it deducts the COGS. And the gross profit, what it tells you is how much does it take you to actually make this thing. So if in the coffee shop example, it's like, okay, well, for this cup of coffee that I'm selling, right, this is my actual product that I sell. This is how I make money. How much does it cost me to get that specifically done? Everything else is to run the storefront, right? Everything else is to have a space, to have the license, to have everything else. But in order to actually buy the coffee beans, the cups and milk, the salary is not included here. So it's really just about what are the materials that you need, how much do you spend on them. Because if you're trying to maximize your profit, maybe this one, net profit. So let's say your net profit is 2,000, but your gross profit, as I mentioned, it's gonna go here. Gross is 20,000. Whoa, you're spending $18,000 on something that is not directly related to your production of the coffee. So what you want to do is, maybe you want to optimize some things here. Maybe you want to fire somebody. Maybe you want to renegotiate the rent. Maybe you want to.
Can you explain about the gross profit? I think for first I understand that gross profit is revenue minus the COGS.
Yes.
Yes, but
yes.
it's 10,000 minus 1,000.
Yes, in this case it would be 9.
Yeah.
Yes.
Ah.
I just gave that number
Uh-huh.
to make a bigger difference, so it stands out more. But yeah, in this case you're spending 7. Well, technically we lost money here. So if we were to actually use this table, we would spend $11,000 on everything else that doesn't require us buying the coffee beans. Okay, so it's really nice. It shows those two different things, and you can see where are you spending the money in your company. Okay. Okay, so those were financial terms. What I want to do is why I didn't go into the slideshow. I found this really cool materials from the Harvard Business School. I'm going to send it to everyone, so you don't need to leave your email on their website. And now they're emailing me every other day, hoping I'm going to sign up for their programs. But what they do here is really cool. So right now we spoke about this income statement template, right? So this. Financial instruments. Let me see if it's this one or this one. Yes, this is the balance sheet. That was the financial statement. And then I think the cash flow is something else. That's actually an interesting question, but we'll talk a little bit about it later. So here you can see the net sales. That's our revenue. The cost of sales, these are COGS. And you can see the gross profit right here, right? Then it's the selling and operating costs or expenses, general administrative expenses. So you can get total operating expenses. Then you can get the incomes that you get. Maybe, okay, here's an interesting one. So you have $26,000 left in cash here. They shouldn't be just cash. Put them in a savings account, right? They can make you 4%. If you're making 4% in a bank, or maybe you even invest some in like Starbucks, just so that you compete with the Starbucks, but you also make money if they grow, you will put that into the other income. So something that you don't get from specifically making your product. Gain loss in financial instruments, that's the financial instruments like Starbucks stocks, for example, right? If you have foreign currencies, for example, you buy your coffee in Colombia, what if their currency is going to go through the roof? Maybe you want some saved up. But then that currency changes and you either make money or lose money. Maybe you have a bond of that country. And so then you can see what else is left here. Interest expense, yes, that's your liabilities. So income before taxes and then income. You can see there is no CapEx here, which is kind of sad. But you can take this as a template and expand on it. Or I can actually find maybe an even bigger, broader one. Do I have one? I also have this table that I can share with every one of you. And this is something that I just did in 5 minutes. And then the other thing that I want to show is the balance sheet. And I kind of like their template. So, okay, what does this gap means in IFRS? So when you do the balance sheet, what exactly do you put on this balance sheet? Depends, right? So we spoke about the assets, we spoke about the liabilities and equity. Those are like 3 umbrella terms, 3 categories. But what exactly do you put for assets? Do you put your patents here? Like, is that your asset? Can you make money if you sell it to somebody? So there's this thing as GAAP, and it's called General Acceptable Accounting Principles. And basically there is the US company that came up with this standard. And why did they do that? Well, because again, there is so many different industries. There is medical industry, there is industrial, there is software, there is coffee shops. All these different industries, they have something different inside of them. What they did is they've basically standardized it across all the industries and said, you know what, this is the bare minimum that every single company has to do in order for investors or IRS, right, they want their taxes, to quickly see across all the industries and compare companies. However, later on in the classes, when we are going to be looking at the public companies, we will see that a lot of them use, on their earnings, they write non-GAAP balance sheets, which means that they add something that is specifically unique to their company or their industry. So it's not standard, but they think it's important and it shows the better picture. So both are important, both are good. If the company gives you non-GAAP, it's still relevant, it's still useful. It's just something that they think is more useful than the regular GAAP. The IFRS is a similar thing, but for the worldwide. So they have their own standard. And again, it's kind of what we've covered today. So the assets here is the current assets. Okay, this is important. What's the difference between the current assets and the non-current assets? It's very easy. The current means this year.
Turnover period.
It's exactly, yes. And the non-current is something beyond this period, beyond this year. Usually it's a year. But yes, everybody's companies, they don't all start on January 1st, right? So every company has their own kind of start date. And you can see there's a cash and cash equivalents. Cash is just the regular cash. Cash equivalent could be like a safe note, something you put in the bank. Accounts receivable. Who knows what accounts receivable is? Okay, if you're making coffee, let's go back to the coffee example. And what you do is you do catering as well. You start a catering business as part of your coffee shop. And there is 10 companies that all hire you on a monthly basis and they ask you to bring coffee for $1,000 each, right? So for months, you've spent your money. You've spent money to make coffee for your employees and everything. So you've spent the money. They would pay you $1,000, but then they come back to you and say, usually in the contract, they say that after you put an invoice, after you put a bill, the company has like 30 days to pay it. Sometimes it's 60. The company comes back and says, you know what, the economy is really bad. Like, I don't have money right now. I don't have a credit line in the bank. Can I please pay you in 3 months from now? All of that money that you will receive from the companies that you've provided service to is called accounts receivable. So it's still kind of like your asset. It's just that somebody else has that cash and you don't have that cash available yet, right? And then the inventory, that's the coffee, the coffee. Beans, cups, things, tables, chairs. No, sorry, not the tables and chairs. Other current assets, something that you also have. So the property, plant, equipment, long-term intangible assets, and some other stuff, that all goes into the non-current assets, which makes sense. It's not really applicable to this specific year or period. Then you have the liabilities, also divided into current and non-current. The current portion of long-term debt. So you took the loan from the bank. Maybe you sold bonds. We'll talk about selling bonds later. Actually, next week, we'll talk about selling bonds. Accounts payable, similar thing, but now you buy coffee beans from another company. They gave you the coffee beans. You already sold it. You have accounts receivable. But the company that sold you the coffee beans are still like, hey, where's my money? And that's your accounts payable. That's something that you own this other company. Accrued expenses, something you've spent. Current liabilities is a long-term debt. Any other liabilities? If you took a loan from somebody on a personal basis. And then finally, the shareholders' equity, right? We spoke about the equity. This is the third piece in the balance sheet. And there's a common stock, and then the actual earnings, total shareholders' equity, and the liabilities to them. And so we spoke here that if we have more than one person owning the company, then this would be, founder A equity, 43,000, which is 80%, and then founder B is going to be 11,000. But then also the liability that we have on the company is also going to be split, right? So it's not like I own all the liability and just a little bit of money. The liability is also split between the founders. So they will need to pay that in their proportions. Okay, are there any questions at this point about the financial, the P&L sheet and the balance sheet? Seems pretty clear. Very useful. Okay. We are going to go back now to the presentation that I had somewhere there, but No, this is not a break yet. Just had. Okay, so back to interesting stuff. The shares and equities, right? That's where we kind of like took this side step to go into the balance sheets. Let me see. Yes, I want to talk about this. This one. Okay, so this is where we came in with our own money. And
Maybe quick summarize for
what would you like to summarize? What would you like?
Point for what we need to know this. It's some matches with shares or something like this, and maybe some quick example for how we can use this.
Yes. Yes.
And,
I really like this quote here. So the money for business is like food for humans. We need to survive, right? If we don't have food, we'll die. But then, as a human, we can strive towards something, and that's our purpose. The company's vision is our human's purpose, right? So the money is incredibly important. If I have a vision, if I have beautiful vision of peace in the world and everything else, it does not matter if I don't have food on the table. It's the exact same for the business. So the money are important for the business, and these two things give you a very easy insight into how much money do you have. It's like opening a fridge. If you open a fridge, you can see how much food you have left for tomorrow. If it's completely empty, you're going to the grocery store or ordering some food. So if you're opening this up and there is no money left in the business, well, the business is going down. If there is a lot, then the question is like, what do you do with it? What is your vision? So I think that's what these things are important for. They're also incredibly important for the investors. Because when an investor comes in, or you come to an investor, more likely than that, you come in and you say, hey, I need some money because my business is doing actually pretty great, but I want to open 3 more locations. I don't want to take the loan. I actually want you to partner with me. They were like, okay, that's cool, but how can you prove this? Can I see the P&L statements and the balance sheet? Who else do you have on your business? Do you have partners? How many? If you are a coffee shop and you have 20 partners on your balance sheet, kind of weird. You have your mom, your dad, your grandma, everybody's there, everybody's getting half part. So the investors are going to be like worried about that. So again, these two things are important for investors, are important for us as the founders. I mean, honestly, sometimes they're incredible for employees as well. But you will see every public company, they will have to post this, right? The GAAP standard that we spoke about, they have to open up their books and show us what they have. And if they don't, that's called fraud. So that's how I would summarize that part. And then go back to this. A lot of times we talk about percentages here, right? But where do they come from? Well, what are the numbers here? Like when we buy shares on the stock market, we are not buying the percent, stock exchange doesn't write, let's buy you a 0.00001% of Apple. You say, I want to buy 1 share of Apple. So these percentages, they come from the shares that you own in the company. And usually, the company has 2 things. The name of one that I forgot right now, I think it's something like, allocated. Right on, allocated. So allocated shares, and usually we start with 10 million of them. So when my partner and I, we opened the company, what happens is when the company starts and we register our C Corp in Denver, we allocate 10 million shares from this pool. And we don't own these shares yet. So if we were to go and sell it to somebody, what these shares would do is they would vest. They would actually be issued. So at this point, they're not issued yet, they're just allocated. What this says is that, okay, well, how much money are we putting into this business? And let's say we are putting $10. how much each share costs. We take $10 divided by 10 million, and we get something like, God, it's either this or this. I don't know. So this is how much each share costs, and that's a cent, right? So if I wanted to buy the whole company, I need to bring $10 and buy all 10 million shares, then they get issued. And then I can sell them to somebody else. So when this process happens, when the company moves from allocated shares to issued shares, this is called primary market. But then if I want to take these issued shares and sell it to somebody else, so there is this investor comes in, right? This is called secondary market. So when the company goes public, they issue some amount of shares. They don't have to issue all 10 million. They can choose to issue only 2. Because what is happening when they're going public? When they're going public is all they do is they raise money from people. So what they say is, okay, well at this price, all we need is $2. It's a funny example. So let's improve it. Let's make this company now worse. So we have 10 million shares, and it's going to cost $100 million. So that means that each share costs $10. Right? So now the company doesn't need $100 million today because it's too much cash. They wouldn't be able to do much with it. They don't need it. All they need is $20 million because they want to hire more people, to buy more equipment, and they've calculated that all they need is $20 million. They don't have to issue all 10 million, they will issue 2 million, sell it at $10 on the public market, and that will be called primary market sale. Or in case of IPO, it's initial public offering. But then, as soon as we bought directly from the company, or stock, no, not a stock, hedge funds usually do, they will start selling it to everybody else. So when we go and buy Apple stock today on the stock exchange, we are participating in a secondary market, where the price of this share, when I buy Apple stock today on the stock exchange, Apple doesn't get anything from that. They don't get money from that sale because they already got their money on the IPO. IPO day is when they get money. So what happens here is I pay this money to somebody to buy their share. Apple doesn't really care much. They don't get any money. They also can't really block this transaction. There are times, so this is public company, right? When it's public, everybody can buy it. If some big hedge fund comes in and buys all 20 million shares, well, now they own 20% of the company, and they can start pushing their decisions on the company. They can say, you know what? Nature is important. We want all the products being done carbon neutral or something, right? And we'll talk about that and how that's possible, if that's possible, because there are different types of shares. But before we get to that point, what we were just talking about is kind of like trying to value the company. The valuation of the company comes from 2 things. How many shares have they already issued? And what was the latest price on the share? So in this case, not issued, allocated actually. So how many shares have been allocated? And what's the latest price on the share? In this case, the valuation of this company is $100 million. Let's now go back to our coffee example, right? Make it a little bit more relatable. So our coffee shop here, if we recall correctly, we've put $60,000. This number, 10 million, is completely arbitrary. Okay, you can come up with whatever number you want. It's suggested to be this number because it's easier to divide it. So if you hire a founder or you get employees, you can give them part of this shares. If you only gave yourself 10 shares for $60,000, how much would each share cost here?
6,000.
Right. So then you have a founder who comes in and says, hey, I want 20% equity in this company. How much money do they need to pay you to become 20% equity holder. How much?
24,000.
$12,000. 1.5? Yeah. No.
That's right.
Something's not right. Is it? 5? Yeah, that's correct. 12,000. So they paid $12,000 for 2 shares. Now they have 20% equity. That's where we get the percentage. We don't get the percentage first, we get the shares first. But it's just usually easier to operate in the percentages than the shares because the shares usually are huge numbers. So again, if we want to hire employees and we want to give them $3,000 worth of shares, well, now we have to break one share into halves. That doesn't quite work. So what we need to do in order to do that is we need to issue 10 new shares. So we need to make this 20 shares so that each share costs $3,000. And then we can give an employee 1 share and they become also a 1% equity holder in the company, right? The problem with this is that this needs approval of the board. It needs a process, you need documents, you need paperwork. So in order to avoid doing this often, we issue 10 million shares straight away in the beginning. So then we can give our employees 300,000 shares and they have 0.5% in the company. And you can see how those numbers start not to really match anymore. Okay, I think I moved from this slide by clicking the clicker by mistake. So there are 2 things here that are incredibly important: the pre-money valuation and the post-money valuation. What happens here is we talk about investors who come in So let's say again, we have our coffee shop. We issue 1 million shares. Let's make a little bit smaller. We won't need 10 million. We allocate 1 million shares. But we also want to raise some money from an investor. Right now, if you recall, we had $60,000 divided by 1 million. It's gonna be 60 cents, I believe. 6 cents. Okay, so 6 cents costs each share. If they want to give us money, they want to give us $40,000. How many shares do we give them? Like somebody comes in and says, "Yo, your coffee shop is so great. I want a little bit of it. I have $40,000. How much percentage equity do I get?" Well, in order to calculate that, we need to negotiate the valuation of the company. So we need to valuate this 1 million shares that we already have. We issued it at 6 cents, but now we worked on this coffee shop for 2 years. Now it's bringing some money in. So it probably doesn't cost 6 cents anymore. Maybe it has more cash. Maybe it has more equipment. Maybe it has 2 branches. And this investor wants, part of it. So what happens here is we negotiate the valuation. And we say, you know what? We can take your $40,000, but it's going to come at, let's say, $500,000 valuation. So what we said is that this 1 million shares that we have in the company, so we are saying that the whole company that we have right now costs $500,000, $500,000. So we grew it from 60,000 to 500,000 in a course of 2 years, which is incredible. But then now, okay, just for the simplicity's sake, I'm going to say 50,000. So now we can calculate how much percentage they will get. They will get 10% if this number, 500,000, is a post-money valuation. So there are 2 terms. They're very important. They're very important because you can by mistake sell more of your company than you intend to. Because what this means, there's a pre-money and a post-money valuation. Pre-money in this case is going to be 450,000. And the post-money is 5. So the pre-money is simple. It's how much do you value your company before the money that the investor is going to add. The reason why is because this money that they will add is going to go into your balance sheet as an asset. It's going to increase the valuation of your company by 50,000. So the pre-money in this case would be 450, and the post-money is going to be 500,000. The most important part here is that the percentage that the investor owns is calculated on the post-money valuation. So why is this all important? There's this company, right? They've valued their company at $10 million. And they go around and they're looking for investors. And what they offer is they say, hey, we are raising 1.5 million on a pre-money, right? That's all there is on the slide. That's all they say. So me as an investor, I'm looking at this. I'm like, wait a second. I'm actually not going to have, if I put all 1.5 million, I'm not going to have 15% of the company. I'm going to have 13.8 or something. Because the post-money valuation of this is 11. Right? And that's where I'm going to calculate my percentage. Why can this be important? Well, it can be important because who is making the decisions in the company depends on how much equity you have. Right? And that brings us to 3 different types of stocks. So now we are moving away from the LLC. We have created the corporation for our coffee shop. Now it's incorporated. And if you remember correctly, LLC kind of doesn't really have the shares. LLC doesn't have shares. It has operational agreement, right? It's the document where we write out who owns how much equity. Then we have an S Corp. S Corp kind of has shares, but they're only one type. They're only one common share. Everybody owns the same thing. However, in the corporations, there are different types of stocks, different types of shares. There is a common stock. Thank you, Vanya. There's a common stock, and the founders and employees usually get this. And you can see that the voting rights that this stock gives you is 1 vote per share. So if you were to have 10 million shares and you have 1 share of Apple, you come to the Apple's board meeting and they're like trying to decide who to hire next as a CEO. Tim Cook is out. We want the new CEO. Who should it be? What happens is the board has to decide. When you buy shares on the stock exchange, sometimes you will get a mail. Sometimes you will get an email that will ask you to do the vote. Apple does this. A lot of companies do this because they issued common stock when they IPO'd and you bought it. And then 3 months later, when there is a decision to be made, they send you the mail and they say, hey, you have a share, so you got to vote. Send us the proxy. What's the proxy? Well, it's like you kind of giving your decision, and then there will be a person on the board that will collect all these proxies from everyone who owns shares. They will come to the table and they will say, well, 8 million people or 8 million shares voted to put a CEO this person, and 2 million voted this way, and thus we have this new CEO. So some shares give you just 1 vote. There is a class B that gives each share 10 votes. So now you can have 80% of your company, or let's say this way, you can have 45% of your company, and then this other person has 40% of the company, and your employees have the last 5, right? But what happens is that you have this 45% of a Class B common stock, and your votes matter much more than anybody else's. So you still get to choose whatever you want to do with your company because you're the biggest shareholder and the biggest kind of like voter. That's what the Mark Zuckerberg does. That's what Evan Spiegel does in Snapchat. A lot of tech companies do this, where the founders want to still have ownership of the company and want to make, their own decisions. If Zuckerberg wants to buy Oculus, he can just do it. He doesn't need anybody's approval because he has the most shares. He tells, hey, I want to, if Elon Musk wants to start building new cars, or he wants to loan the resources from one company to another, he can do it because he has the voting shares. The board can come and say, you know what? We don't like that. They can try to go into the court, they can appeal. But whoever has the most voting shares most likely is going to have the control over the company. And that's important because when you're investing into some other companies, or you're buying on a stock exchange, or you're bringing somebody in and they tell you, hey, I actually want this Class B common stock. Don't give me this stuff. You gotta be accurate there because you don't want to give up your company to somebody else. That's kind of what happened to Steve Jobs, right? He was a CEO, he was a founder, but he was fired because the shares weren't giving him enough voting rights. There's a lot of those examples. And then there is a non-voting common shares. They are usually given to employees and passive investors. Those don't have any voting power, but they still have equity. And if there is going to be dividends, then they will be getting those dividends. Important thing here, liquidation priority. It all says last here. Upside potential is high, which is great. But I'll come back to liquidation priority. The reason why all of them are the same, but there is also something different. There's 4 more different types of stocks. And you thought you'll be done, huh? It's just 3. There's 4 more. All of them are preferred. All of them are preferred stock, and some of them just have slightly smallest little differences between them. Different investors, like different ones. And again, if they come to you and they want to negotiate something, you would want to understand what are they trying to get out of my company. But the preferred stocks usually don't give voting rights. So investors can participate in the growth of the company. They can grow with your coffee shop, but they're not going to exercise any voting. They're not going to push you to do something. They're not going to push you to open the store in some other country. They can't do that. However, why this is a preferred stock is because when the company raises the next round or sells to another company, so let's say you've built a software company and you're selling it to Microsoft. If you've put in, let's say you've raised the money from investors, you've raised $10 million from investors, and you sold your company for $12 million, or even 9. Let's say you've lost company, you still built some software, but it didn't get to be that great. What your investors want is they want their money back, right? They don't really care about you making money. If you didn't make them money, at least they wanted to get their money back. And that's why these stocks, they have a liquidation priority before common, which means that whatever money the company gets from sale, acquisition, the next funding round, they get to choose first if they want to sell their stock. I'm not going to go into other details of why these stocks are different. What you can do at some later point, you can come back here, refer to this. You can obviously Google, use other services to kind of dig deeper when you need it. I think it's an overkill right now. You don't need that information. But the preferred stock, that's the most important part. And these 3 are also important because they will help you understand how to structure my company. Common mistakes with the early equity. These are important things. Splitting equity evenly. Usually it's a very bad idea. Having 50-50 with your partner is a very bad idea. Never have 50-50 with your partner. Especially if those shares have the same voting power. Because when you will need to make a decision, and you will, if one partner wants it to be one way and another one wants another way, and you can't make a deal, that usually happens in divorce cases, right? We're all 50-50 in a marriage. if we don't have a prenup. If we're 50-50, we are going to court. Because if we can't decide, somebody has to. If you're 50-50, it's a pretty troublesome situation. And investors don't want to see that either. They want one person who is in charge, who is important, who is going to make decisions if there need to be made. You would usually make them together, right, as a team. But usually it's the CEO who has the most equity. And that's a great place to take your ego off the table. If you are a second, a third, a fourth founder, that's what it is. Your first CEO is the most important person in the company. They give you the vision. Then you play by those rules. If you want more equity, go open up your own company. Do not try to kind of like fight them over. Because the important part of opening the company is the success of the company, not you as an individual. No vesting schedule. We have not spoken about the vesting right now. I'm going to come back to this in a second. Forgetting to allocate an option pool. This goes alongside the vesting. And also not accounting for, I'll come back to this, not accounting for taxes or legal documents. If you're starting to create all these different types of shares, with everyone, there's a lot of paperwork that you need to do. A great lawyer and a great accountant are incredibly important in all of this stuff, but they're also very expensive. So going back to your question, if you're all of a sudden moving from LLC to corporation, the legal is going to be rad. It's going to be like really rad sell because there's going to be a lot more expenses and a lot more unknowns on like what's going to be needed in order to move from LLC to corporation. Now, I want to go into hiring people. I don't know if I have it here. I do. Yes, it's right here. Right on. Okay. So when you're hiring people, you're hiring an employees, you don't have to give them equity, but you can. And there is a lot of different ways to do that. A lot. The most common ones are stock options and RSUs, the restricted stock units. The restricted stock awards usually apply to the founders. And I'll explain more about these things in a second. Stock appreciation rights is quite unusual. The phantom stock is basically the bonus, right? If your company performs great, what you can say is like, hey, I'm going to allocate some equity to you, but I'm not going to give you shares because I don't want you to vote or participate in my company growth after that. But I'll just give you the bonus based on whatever success we've achieved or higher valuation. So for example, you're going from one round of investing, funding money to the second one. What you do to your employees, you don't give them equity. You tell them, hey, when we raise next round at higher valuation, I'll give you a percentage of that. So today we've raised $10 million, and in 2 years we are raising $50 million. Of that $50 million, I'm not going to give you stock, but payment, well, I'll give you like 2% of that raise or whatever that negotiation is. Employee stock purchase plan is actually pretty common. It's great in the public companies. So I'm going to come back to this first three. So let's start with the restricted stock awards. When you create your company, when you get the shares, when you receive the shares from the company, at that moment, what happens is they're taxed as your regular income. So I think more of you are employees some of you are employees at the software companies who might be getting restricted stock units or stock options. And what happens is when you either, not the stock options, but the restricted stock units, when you get them, they count as your regular income. So you will need to pay your regular income tax on them. So let's say you're receiving 500 shares at $20. 500 shares at $20. you get $10,000 a month. So these $10,000 are your regular income as if it was your salary, right? So you pay your regular income on them. And what happens here is, what usually happens is that out of this 500 shares, your stockbroker, your broker, is going to sell the part of them, like let's say 60 in this case, whatever your regular income is going to need. But they will sell 60 shares and you will never get them. You will never get these 60 shares. They're going to sell them for cash, get that cash, and pay IRS the taxes for you. So that's very convenient. But when you're given, from the company, you have your agreement that says like you're going to get 10,000 shares. When the time comes for you to get the shares, you get less, and you're like confused. Why? The reason why is because you need to pay taxes on that, and it makes it automatically. So then you have 540 shares. When you have 540 shares, they start to grow. They start to go up. This is not cash. This is not your salary, right? This is not something you get into your bank account as a regular salary. These are the stocks that you still need to sell. You need to sell it to someone. And if your company is public, right, you can go on the stock exchange and you can just sell them. So if you work at Apple, you've got Apple shares, you can go and sell them. However, if you're working in a private company, it's much harder to sell them because you need to find the buyer. You need to find somebody who is willing to buy these shares in the company that nobody knows about. So it's much less common to sell the shares in private companies. That's why IPO is such a big deal. That's why a lot of companies, a lot of employees, a lot of founders, they all want IPO. They want IPO because it's so much easier to find people who are going to buy shares. It's all of us here in the room. We're all buying shares. We're buying S&P 500, and then the S&P 500, hedge fund that created that share, they buy shares of other companies. So all of those market kind of instruments, they make it easy for you to sell these shares and make money. With the private company, it's much harder. What I wanted to say, and what's important here, is that when you sell these 540 shares, remember you got them at $20, but now you sell them. Now you sell them at $50. This $30 difference, so whatever the mass is, these are not the easiest numbers to calculate, you're going to pay a capital gain tax on. So there is a second type of tax you're going to pay. If you sold these shares on the day that you got them, capital gain tax, the long-term capital gain tax is not applied. There's two different types of capital tax. There's a short term, if you hold the share less than a year. How many of you know what's the short term capital tax is? Raise your hand. Andrei? Okay, everybody. What's the long term capital tax? Okay, thank you. I can count on you.
0, 1, 2, 38.
Yeah. So for now, for the simplicity's sake, if you buy a share today and you sell it tomorrow, if you bought it at $10 and you sold it tomorrow at $15, that $5 are going to be added to your regular income. You're going to pay your tax, your bracket tax, regular income. If you bought a share today at $10 and waited for a year and sold it a year from now plus 1 day at $15, those $5 are going to be taxed at long-term capital gain tax, which is usually 12% of the difference. So those $5 difference is they're gonna take 58 cents, and all you're gonna get as cash that you can then go and set, buy a house, buy a car, whatever, is gonna be $4.40. Why am I telling you all of this? And I know we didn't quite get to like investments and stock markets and stuff like that. For this restricted stock awards, if you're an employee, if you're a founder, which a lot of you want to be, it's important, there is this form. It's called 83B. If you fill this form as a founder, only as a founder you can do it. Sometimes very, very early employees can also negotiate with the founders to do it, but there's extra paperwork that needs to be done. What you do is you file this form, you print it out, you take a check from the bank and you say, you know what? Today, my company started and I got 10 million shares and I got them all at 1 cent. I paid $10 for them. Those $10 are going to be taxed at your regular income. And then most likely it will take you another 4 to 5 to 7, 8 years to build a company, which means that you hold that stock for longer than 1 year. So when finally you come and do the IPO and you can sell shares, you will only pay 12% tax. So now imagine this, the difference can be enormous. So you got 10 million shares and you never filed that 83B and you got it at $10 and then you go public and each one costs $10 and you got $100 million. $100 million minus 10 is going to be your regular income. If you did this $100 million is going to be your long-term capital gain tax, and all you're going to pay is 12% of this. So you're going to pay $12 million to IRS and keep the rest. Otherwise, it's about 50 to 55%. So instead of having 50, maybe 45, $50 million in your bank account, you could be having 85. Big difference. All you need to do right now is to print out the form, get the check, go mail it, and you can save $30 million potentially. Pretty good decision if you ask me. Restricted stock units is something that the employees get. They go through a very similar process, right? We spoke about this. That's why I explained this first and then came back to RSAs. The stock options are simpler. The stock option we'll come back to this when we talk about the stocks and the options, just so that there is more context about what the option is. I don't want to get too much into it, but what's important specifically here is that if your company is giving you stock options, what means is that you will need to come up with the cash to buy the stock. So in the case of RSU, they promise you 10,000, I think I erased it. They promise you 10,000, they promise you 10,000 shares, you get 500 at a time. They take the tax, they pay the tax, you get the shares. With the stock options, they tell you, hey, if you want, you can come and buy 10,000 shares from us at a lower price later on. But you will need to have cash. So you already have a cash in the bank. You've already paid taxes on that cash. You come and buy stocks right away from the company. And that's the biggest difference. But the problem is that a lot of people think, oh my God, like this company is giving me money right now as an additional benefit. Like I get the shares, I can sell them on the market, I'm going to get cash for my house. But then they found out that they need actually money to buy that stock in the first place. So just be attentive, pay attention to this. Can cost you money. Okay.
Question.
Yes, please.
You said they offer you a lower price.
Yes. Yeah, that's where the part of the option comes in.
So
we'll talk about that.
In general, you can take credit line,
exactly.
Options, sell
yes.
options with a higher price.
Exactly.
Pay your credit line.
Yes. And you're done.
Smaller price.
Exactly. Yeah, that's exactly it. There's a similar situation when you're short in the stock. It's a fun one. I want to find those 4 things to never do as a founder here. So coming back here, we still didn't talk about the vesting schedule, and we didn't talk about the option pool yet. I'm going to leave it for the next week. I know it's a lot of great information here. But yeah, thank you everyone. Thank you. If you have any questions, like Alex, you might have some questions.
He will text you tomorrow.
Yes, you can send them in Telegram, right? Always remember, if you wake up tomorrow and you're like, you come up with a question. How much does it cost to run a C Corp in Texas, right? Or how much money is it going to cost me to send money from here to my grandma? I want to hire her for my LLC. If you come up with any questions, send them in Telegram. or email. And I'll try to get them added to the slides because everyone else can benefit from those questions, right? If you've got a question, most likely somebody else also has that question. Thank you. Thank you, everyone.